It's good news. We are in the dividend season from January to April 2026, when the companies and SACCOs will be distributing dividends to their shareholders and investors. Dividends, by explanation, these are incomes that are given to the investors and shareholders for giving their financial resources to companies and SACCOs to do business with. However, you only qualify to get dividends if the company that you invested shares in has been profitable for that year of income. For instance, if the company that you invested money in by buying shares was profitable in 2025, you will be receiving some dividends. But if the company suffered losses, and many companies by the way do suffer losses, you will not be getting anything. Investing in shares comes with such risk that sometimes you can get returns and other times you can even get zero returns. Okay, assuming that the company you invested in did make profits, then there are two types of dividends that you can be expecting from such a company. Type number 1, qualifying dividends, and type number 2, non-qualifying dividends. This is income that is distributed by a company to its investors and shareholders after the same income has been subjected to corporation taxes. And this is how it works. A company generates revenue, then from that revenue, all expenses are deducted for us to get to the net profit margin. After the net profits, the company has to pay 30% of that amount to the government of Kenya as income taxes. Assuming the company had a net profit of 100,000, 30% of 100,000 is 30,000. And that is the amount the company has to pay to the government of Kenya as corporation taxes. What is left is 70,000, which gets distributed to the owners and investors of that company. But there is a catch. The owners don't get the 70,000 in full. Before that amount is distributed to them, a withholding tax of 5% is deducted and remitted to the government of Kenya. So the 70,000, 5% of 70,000 is 3,500. The investors only get to share 66,500. The 3,500 gets remitted to the government of Kenya. Does that amount to double taxation? Remember, the income, net profit of 100,000, which was first subjected to corporation taxes of 30%, so that we were left with the 70,000, has further been taxed and reduced to 67,000 to 66,500. Does that amount to double taxation? Let me explain what is double taxation. For double taxation to happen, 3 conditions have to be met. Condition number 1, that one person, same income and same type of tax. That this money, this income is belonging to one person, and this income is being subjected is being taxed more than once using the same tax rate. If that happens, then there is double taxation. But for the case of the company having generated income of 70,000 or 100,000 and it paying 30,000 to the government of Kenya as corporation taxes, being left with 70,000, then a further 3,500 being deducted as withholding taxes on dividends, and therefore the income that it needs to distribute to its investors and shareholders is reduced to 66,500. That does not amount to double taxation, because even if you are talking about the same income, yes, and the same type of tax, that is income tax, we are talking about 2 different entities, the company and yourself. Those are 2 different legal entities. And therefore, when the company pays its taxes, you also have to pay your fair share of taxes. That does not amount to double taxation. But there's good news. The withholding tax rate on qualifying dividends is less compared to that of non-qualifying dividends. The question is, what is non-qualifying dividends? Non-qualifying dividends are the incomes that are distributed to shareholders, investors, and equity owners from income of a company that has not been subjected to corporate taxes. This company must be very lucky. Unlike most other companies, it does not pay corporate taxes to the government of Kenya. Sounds funny? Why? The government of Kenya, in its wisdom, gives certain tax incentives to specific companies. More so, those companies that are able to do a heavy and large investment in Kenya, a high investment in Kenya, or to foreign companies. For foreign companies, the government of Kenya understands that they have an option to invest in Uganda, in Tanzania, in Rwanda. What should the government of Kenya do to attract these foreign companies? When they are spoiled for choices, they can go even to Europe. The only way to do that, or one of the ways, is to provide a tax incentive, and that is referred as giving them tax breaks and tax holidays. When a company has been given a tax holiday status, it means for the next 5 to 10 years, it will be paying zero income taxes. It is a good thing. But why? This is the idea behind this proposal or strategy, that when this company finally starts operating here in Kenya, it will employ Kenyans, and Kenyans will be earning salaries. And when they're earning income there, those incomes will be subjected to pay as you earn. So after all, the government of Kenya is not getting zero taxes, it is getting some taxes in form of pay as you earn from employees. It is good to know that even when a certain organization is tax exempted, including NGOs, churches, the person or the entity that is supposed to enjoy the tax exemption status, it is the organization, not the individuals working there. Then they still have to pay as you earn, they still have to pay SHA and NSSF and NSSF. So this company that is foreign is given that tax holiday, tax incentive. It doesn't have to pay taxes so that it can employ Kenyans here, and the government of Kenya is assisted in reducing the high rate of unemployment. Also, this company, the foreign company, once it is here, it has to buy fuel, to consume airtime, utilities, pay rent in the offices that they are occupying, and the government of Kenya charges VAT on those expenses. So after all, this foreign company, we can't say it is not paying taxes. It is paying all the indirect taxes. What it is not paying is only the direct tax in the name of income tax. And there's another benefit, the transfer of knowledge. You can imagine a Chinese company comes here in Kenya to do electronics production, and it employs Kenyans. After 5 years, Kenyans will be so knowledgeable in processing, manufacturing, and assembling electronics. That is knowledge transfer. So that after maybe 10 years, when this company is exiting Kenya, should it choose to do so, Kenyans who will be left behind will be knowledgeable in producing such electronics. So at the end of the day, the government of Kenya is winning. Let's go back to the non-qualifying dividends. Now that we have understood why the government of Kenya can choose to give certain companies the tax exemption status. So if these companies, which have been given tax exemption status for some time, if they choose to distribute dividends to the shareholders and investors in such companies, those dividends are subjected to a higher tax rate, which is withholding tax, of 15%, as opposed to the withholding tax rate that was subjected to companies that give qualifying dividends. The reason for this is to prevent shareholders and directors from taking advantage of tax exemption status that their companies enjoy to profit themselves. That whenever the company makes huge profits, instead of those profits being reinvested back to the same company so that it can employ more Kenyans, increase their production, expand their production, they allocate dividends to themselves as shareholders and owners. To prevent that, they have to be subjected to more pain in terms of dividends taxes, which is 15% as opposed to 5% for the other case. The reason for that is to just encourage the owners of this company to continue pumping more monies and so that they can employ more and more Kenyans. So in short, there are two different types of withholding taxes on dividends. And it depends whether the dividends we are talking about is either qualifying or non-qualifying. If it is qualifying dividends, the withholding tax is 5%, which is final. You don't have to pay further taxes on that income. For non-qualifying dividends, it is 15% and it is also final. It is higher because that income has not been subjected to corporate taxes. It's also good to know, over and above the 5% and the 15%, those rates apply to Kenyan investors. If you are a non-resident, a foreigner, who is earning some dividends here in Kenya, for qualifying dividends, you are subjected to a withholding tax rate of 10%. If you have invested in Safaricom or KCB or any other company that is operating here in Kenya and you are a foreigner, the dividends that you'll be receiving will not be in full. That dividend, if you are entitled to dividends of 10,000, you will only get 9,000. 1,000 will be withheld and be paid to the government of Kenya as withholding taxes on dividends. If you are a Kenyan, it is only 500, you will get 9,500. For non-qualifying dividends, what will be deducted from you is 15% if you are a non-resident. When you know better, you do better. Don't question those companies that you have invested in why they are paying you something less. It is because of the withholding taxes that dividends have to be subjected to. It can either be 5% or 15%, depending whether the dividends are qualifying or non-qualifying.